have omitted something, then it's not really necessary. Because I will talk about every single thing that one can consider to be, let's say, necessary. Please, I hope my mic isn't on mute. Can you guys hear me? Because I muted my mic. Please, can you guys hear me?
Yes, we can.
Yes, we can hear you.
Perfect. All right. Now, this is a chart. What we have in between the chart is a candlestick. Multiple candlesticks. Multiple candlesticks. Candlesticks are simply, let's call them alphabets. Alphabets that we put together to serve as a medium of communication. Medium of communication, a language that the market speaks. So no matter where you are in the world, if you can read price action, when candlesticks form and form and form and form, we call that price action. Market structure ultimately makes up a price action. Candlestick makes up a market structure. Market structure makes up a price action. Market structure can be divided into three, or rather two. We have a trending market structure, either trending upwards or downwards, and we have a consolidating market structure, neither up nor down, choppy like this. Something like this. Please, I'm coming. Please, if you don't understand what we're doing, just calm down. We have about a month. Look at this. This is choppy. It's neither going up nor down. It's in between. But here, this is a market structure that's bullish in an uptrend. Because when it spiked up, it broke this structure. It broke this structure. So we can see this is a bullish market structure. Now, that's not the point. Every candle has an open, has a low, has a high, and has a close. We have two types of candles. We have the buyer's candles and we have the seller's candles. Now, since just like human beings, we have human beings that are tall, that are tall. We also have human beings that are short. We also have human beings that, God forgive me, we refer to as handicapped. Same applies with candlesticks. We have candlesticks that are huge, fully formed candles. We have candlesticks that are not really huge. We have candlesticks that are seemingly handicapped. I will go to the chart and show you what I mean. Now here, this is a fully formed candlestick. If you come here, this is something that's not really like a candle. You might be wondering, what the hell is this? Look at it here. We have another one here. We have another one here. And look at this. We can say this is a candle. And look at this. Well, what is this? Not necessarily a candle. But all of these are candles. The same way we have human beings that are fully human. We have human beings that are extraordinarily humans. They are giants. We have human beings that are normal. We have human beings that are short. We have human beings that are skinny. Same applies with candles. So when a candle is a normal candle, we can refer to it as a candle. When a candle is like this, we can refer to it as a doji candle. Please, guys, I cannot feed you everything, but I will be mentioning stuff that going forward, if you do get a mentor or you do your personal research, it wouldn't sound strange. Like, okay, I've heard this during the bootcamp. Okay, so you're not completely dumbfounded. We have candles, and I would make sure I focus on the most important ones, popular ones that are occurring in the market, ones that are relevant, that are usually relevant once you see them. By mere looking at this, well, let me show you another one. Please, what does this look like? Farouk, don't answer. What does this look like? Well, I have successfully told you that a candle, just look at this. A candle has
Like the
an
hammer.
open, a low, a high, like a hammer. Like a hammer. Now, I told you every candle has an open, has a low, has a high, has a close. Now, this is a bullish candle. So because it's a bullish candle, bullish candles normally go up. Yeah, just look at this. Bullish candles normally want to take the market upwards. So because they want to take the market upwards, they normally open at the bottom and close at the top. Bearish candles, because they want to take the market downwards, they normally open at the top and close at the bottom. So that's the difference. Okay. These long things you see here are things we call wicks. Wicks. These are things we call wicks. 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 These things are things we call wicks. And they matter. So the more you see a candle form, the way you see a candle form, it should tell you what is happening. If you see a candle forming fully, it should tell you that there's so much volume, and yeah, it should tell you there's so much volume in the in that candle, and it's giving you a signal that the candle that has formed, the people behind that candle are in charge of the market, depending on the time frame. I'll tell you what a time frame is once we get there. So please just know that we have two types of candles, the bearish candle and the bullish candle. The bearish candle opens at the top and closes at the bottom. It makes a high and it makes a low. Why does it make all of these things? We'll get there. We have about 30 days now, or rather 20 something days. So calm down, calm down. We have the bullish candle. Because the bullish candle seeks to take the market higher, therefore it opens at the bottom, close at the top. It makes a wick normally that makes its low, and makes a wick to the top that makes its high. Don't worry, we still have a month and we still have a year, God willing. So it will make sense. Once you go on your self-study, it will make sense. I just want you guys to be conversant with these terms, conversant point of interest. I will show you how to identify point of interest, POI. But because the robot cannot really ascertain that the hammer that formed didn't form at a valid point of interest, the robot would just place a trade, a reversal trade. Since the market is going upwards, a reversal would mean coming downwards. Meaning if the market is going upwards, buying, a reversal would mean coming downwards. If the market is going downwards, a reversal would mean going upwards. I hope I'm making sense. So normally, if you see a hammer form at your POI, it's part of a signaling reversal. There are many other confluences to watch out for. Personally, I don't go with hammer. I don't look out for hammer. There's something we call engulfing. This is where candlestick patterns comes in. What an engulfing is let's see this candle. We have a candle here. This has engulfed this. So if the market is going up and it comes to your POI and you see a candle, a reversal candle, meaning a bearish candle, since if the market is going upwards, you would want to see bullish candles predominantly. So if the market wants to reverse, you would want to see a bullish and bearish engulfing, an engulfing candle form at your valid POI. So it doesn't matter if we have an engulfing somewhere around here. As long as there is nothing to suggest or infer that the market is at a zone that is likely to push it downwards, it's normally a false signal, which a robot wouldn't be able to identify. Please, I'll go to the chart. I'll find the chart now and I'll explain to you. Just calm down. Now, if you can see this chart, as you can see, the market was previously on an uptrend. Previously, when it reached here, now here is a point of interest. I'll show you how to identify a point of interest. When it reached here, what happened? A candlestick formed. The liquidity was, God, this is too advanced for you. This is too advanced for you. Kai, you won't understand what I'm saying here. I didn't explain liquidity, so this would have made more sense. This is too advanced for you. God. Please, I'm sure many of you are already confused. Wicks or shadows. Yeah, we call them wicks or shadows. Please, just know that what I've explained to you earlier is simply the anatomy of candlesticks. Candlesticks have wicks and they have bodies. Their bodies normally have the open and close. Their wicks normally have the high and low. There are candles that form without wicks, and there are candles that form without body. Candles that form without body, just wicks, are normally candles that indicate indecision, meaning 50-50 power in the market. The bulls are in charge just as much as the bears are in charge. So the buyers are in charge just as much as the sellers are in charge. Whenever you open a chart to put everything together, listen, I told you it's going to take you a year to attain mastery in this thing. If you think you can do it in a couple of months, good luck. Once you open your chart, I told you, the price is here. Time is here. Candlesticks, buyers' candlesticks are here. Sellers' candlesticks are here. Meaning it's a marketplace. And in the marketplace, we need to have buyers and sellers of a particular instrument, which is normally here. So if yeah, so there are different ways of conducting a transaction. There are different ways of conducting a transaction. Whatever you see on the chart is a sign, is a representation of transactions, orders that the market makers fill. Orders that the market makers fill in respect of an instrument that is traded. I told you there are different market participants. The people that move the market, make it go upwards or downwards, are the market makers. They have more money than any one of us. So if you find out that amongst the market makers, the buyers are more in charge, you will see the market going upwards. If you open your chart and you conduct your analysis and you find out that the sellers are more in charge amongst the market makers, you will find a way to sell with them. And this is where analysis comes in. How do you analyze? There are three different ways to conduct your analysis as far as I'm concerned, as far as I know. Three different ways. After you conduct your analysis, you then get to develop your bias. Based on what we've analyzed, Tinubu will win this election. So that's a bias. You have a bias that Tinubu will win based on your analysis. Most of the sitting governors are APC governors, most of this are that, most of this. Therefore, based on my analysis, my bias is Tinubu will win the election. So that's how to develop a bias. Analysis, we have three types. We have the technical. Once you open your chart here, once you open your chart and you use pure price action, historical price action. Technical analysis is simply using of historical price action to determine future price action. Because normally once it's August, farmers tend to buy seeds and farm. Next August, I will anticipate farmers will buy seeds. Therefore, I will provide seeds in anticipation for August. Once August is here, I will bring out my seeds and sell to farmers. So I am using historical price history, or rather price movement of a certain instrument to determine future events, future occurrence. So because I have noticed that every August, farmers tend to farm and they tend to farm with seeds, I would say I will make sure by August I have seeds that farmers can then buy from me for them to conduct their farming activity or whatever. So that's you using technical analysis to conduct your analysis. Now, when you look at a chart, of course, since I mentioned every August, this is where time and price theory comes in. We have three sessions majorly: the Asian session, the New York session, the London session, and the New York session. When using time and price, there are different ways of using time and price. Kill zones isn't the only factor you factor in when using time and price. You would want to make sure that you identify times that the institutions are normally there to put in their orders in the market, to then follow them. Because when they are normally present, that's when volatility tends to become even more in the market. And listen, let me tell you a single hack. I normally take my trades around 10 a.m., 11. I normally look for my setups around that time, 10 to 11, and they normally form. So it's very difficult for me to go 5 days in a week, every day opening my charts from 10 to 11 without actually finding an opportunity. It's rare. So I open my charts normally from 8 to 9. If I don't find a setup, normally 10 to 11, I would find a setup. I don't trade in New York session. I hardly trade in New York session, but I look for ways to enter the market from the London session going into the New York session. So this is just my personal, should I say, my personal strategy, so to speak. Please, if you are confused, just calm down. We have about a month. I'm just trying to give you a general overview of how the market works, and then we'll take it bit by bit. Yesterday, I explained orders. When you're buying or selling something, there are different ways to buy or sell it. I told you could buy or sell something instantly. They tell you the current price, you buy it or you sell it. You could use a pending order. There are different types of pending orders. You could ask for the pricing of a particular instrument. Once they tell you the pricing, you would say you are not interested in the current price. You would want to wait for it to fall down a bit for you to buy. Or rather, the seller might give you a signal that it is very unlikely for the price to fall. From 3,000, we expect it to continue spiraling up 3, 5, 4,000. So you might as well want to buy. And then as a smart person, you might say, well, if price of so commodity refuses to fall back from 3,000 to, let's say, 2,800, and it continues going up, please just buy for me. Let's say buy for me at 3,300 before things get out of hand. So that's a stop order. But pending order is if it's at 3,000, but you want to buy at 2,500. So you waiting for it to come down to 2,500, having placed your order, your pending order, your limit pending order, that means you are using a limit order. Please, if you need more clarification on this, you could use YouTube or Google to do it. But my aim and objective is to expose you guys to these concepts, expose you guys to them, help you know about them. Attaining full understanding of them is something you would have to do at your spare time. So yeah, orders are of two types, instant and pending. Once we get to the practical aspect of things, the day I will use my phone, you will see me place a pending order of the 4 types of pending orders we have, because we have the buy limit order, sell limit order, buy stop order, sell stop order. So that's 4. Please calm down. Wallahi, they are very easy. It's because you aren't conversant with them. That's why they might seem really complicated, but they're very simple. Now, concept of pips and pipettes. This is very, very important. You know why? Well, you have money. If you don't have a metric of calculating that money, it's stupid. It's as good as you don't have money. So we have cents, we have kobo, we have pennies. That's literally measures we use to calculate the money we have. Same applies in trading, especially forex. The stocks might not use pips. You might hear tickers. They call it tickers. But here in forex, what we use is pips and pipettes. The same way a clock has, let me see, do I even have a clock here? The same way a clock, if you can see here, a clock has a second, minute, and hourly cursor. Same applies. Same applies to the concept of pips. Why? Well, I'm coming just a moment. Pips and pipettes. There is the overly complicated way of calculating pips and pipettes, but I'll go with the simplistic way. Just know that pipette has to tick 10 times before we have 1 pip. So 10 pipettes make up 1 pip. Ten pipettes make up 1 pip. So if you are trading any instrument in forex, how do you then identify a pipette from a pip? The spelling is. How do you then differentiate a pipette from a pip? Trust me, these are things that you need to take your time later on to do your personal research. Trust me, it's really simple, guys. Please, it's because it's the first time I'm mentioning it, so when I see it. Let's say you want to trade GBPUSD. Want to trade GBPUSD. And the current, just a moment, please. The current pricing, let me pick up a number. Let me find a number to use. Let's say the current pricing of GBPUSD is 1.20297. It doesn't matter what the pricing is, just calm down. This here, this 7 here is the pipet. So the pipet has to tick 10 times before this pip moves 1 time. Guys, it's very simple. I promise you it's very simple. Now, let me open up the chart. Just a moment. All right. You see, guys, if you can see what I'm doing here by the right hand side, this is where the pricing is. Just here. This here, the 0 here, this is the pipet. The 7 here is the pip. So the 0 here has to move from 1 to 10 for the pip to move to 8, from 7 to 8. Just look at it here. I'm coming, please. Just a moment, just a moment. Now, look at what I'm moving with now. I'm sure you can see. Look at the numbers. Currently, the number is 1.07424. So I'm going to move. Let me change the time frame. All right. Let's look at the number again. The number is 1.06835. So I told you the pipet has to move 10 times before the number before it moves 1 time. So we need to have 10 pipettes before we have 1 pip. The same way that on our clocks, we need to have 60 seconds before we have 1 minute. Same applies here. We need to have 10 pipettes before we have 1 pip. Now I'm going to move this cursor a little bit. Once this 5 reaches 9 and then 10, this 3 will change to 4, meaning 1 pip. Just look at it. Oh God. Let's do it again. It's currently 0.06823. Once this 3 reaches 9 and 10, the 2 will change to 3. 4, 5, 6, 7, 8, 9. Boom. It has changed. It has changed to 3. So we just had 1 pip movement. I'll do it again now. Another 10 pipettes. 1, 2, 3, 4, 5, 6, 7, 8, 9. Boom. That's 2 pips. So that's how to calculate pips in a simplistic way. You just need to make sure that your pipette moves 10 times and then boom, 1 pip, 2 pip, 3 pip, 4 pips. So it doesn't matter what the current pricing is. What matters is the pricing you enter. Now, let me give you an example of how orders work. If price is currently here and I decide to place an order, let's say I sell. It's loaded. Why is it not executed? All right, I just placed 2 orders now. Here is the line. This is where pricing is. Well, this thing is using system would be very much difficult. So maybe I need to use my phone. The day we'll go over this practical aspect of the thing, I'll have to use my phone. But please just understand that this is how the concept of pips and pipet works. This 7 here has to move 10 times. So from 1, 2, 3, 4, 5, 7, 8, 9, 10. So once this 7 reaches 9, this 9 here will move plus 1. So let's say we have 9 here. And then boom, it reaches 10. This 9 here will move. And then it turn down, come back to 0. Meaning we just had 1 pip movement. If this moves to 9 again, and then finally 10, this here would change to 1. This here moves from 0 again to 9, and then 10, this here would change to 2. This here moves from 0 to 9 to 10, this here would change to 3. So we just had 3 pip movement. It's very simple. It's very simple. I could do it with a formula, but many of you hate mathematics here. 0.0001. This is the formula. This is the formula. So if you want to add Nagafauk, where 4 zeros and equal 5 zeros, honestly, I forgot it. Okay, you said guys going smoothly, hammer. It's always the 5th number after the decimal point. Yeah. It's always the 5th number after. Perfect. It's always the 5th number after the that is the pipet. Perfect. Well, there's the formula for calculating it, and it's really irrelevant. I don't want to start scaring you guys. Oh, just
5 0.
5 number. Okay, 5. So the last number. All right. Thank you. The last number is the pipet. Once it moves 10 times, the number before it will change, will add 1. Once it moves 10 times, we'll add 1. So from 1, 2, 3, 4, 5 to 9, we then have 11. So if this thing moves 10 times, we have 1. If it moves 100 times, we'll have 10 pipettes. So pipet has to move 10 times for us to have 1 pip. And pipet has to move 100 times for us to have 10 pips. Why is pips important? Well, this is where lot size will come in. Guys, trust me, this is very simple. The explanation I'm doing now is not enough for you to have a full understanding of it, but I told you my aim and objective is for you guys to become aware of these things in such a way that if you want to go on your self-study, you have already heard it, so things would begin to make sense to you during your alone time. We have 3 lot sizes. We have the mini lot, standard lot, mini lot, micro lot. Like, teaching the basics of forex is the most difficult thing to do. That's why you hardly see anybody take. People prefer mentorships. Like, you already know what you're doing, so I'll mentor you and just help you furnish your edge. It's much more easier than teaching you the basics from the beginning, especially online. Like, were we in that? If had it been it's a physical class, it would have been very much easier for me to explain this stuff. So I'm just really trying. Now, the concept of lot size is very important. It's very, very important. If you trade and you get 10 pips, you might get $10 as profit if you are using a mini lot, but a person using a standard lot haven't gotten the same 10 pips would be getting $100. But you, because you're using a mini lot, you'd only get $10. The worst of all, if you're using a micro lot, when someone is getting $10, you'd be getting $1. So when someone is getting $100, the person using mini lot will be getting $10. The person using one micro lot will be getting $1. So this is where the concept of risk comes in position sizing. Or rather, let's call it position sizing. Please note down these things. You will take your time and do your own personal research. Position sizing. Everything I'm doing here is not enough to give you guys mastery, but it's enough for you guys to become enlightened, aware. So that's really it. If you want mastery, do it on your own, or we'll find a spare time for that. But now we have so little time, and I need you guys to become aware of most of these things. So we have standard lots, we have mini lot, and we have micro lot. All of these things, position sizing, all of these things mount up to help you when you are positioning your sizing or sizing your positions. Yeah, when you are sizing your positions, you need to know that. Listen, just because someone is using a private jet when traveling, doesn't mean you will also use a private jet if you want to travel. So when someone is using a private jet from Lagos to Abuja, someone would be using a car from Lagos to Abuja. Someone would be using a public transport vehicle from Lagos to Abuja. So this is where position sizing. There's sizing to it. There's levels to it. So you need to become your equity. You need to know your equity, meaning your money. You need to know your money. How huge is your equity? How huge is your money? For you to then know how to position size your trades, how to size your positions, how to size your trades. If your money is enough to open positions using a standard lot, you will use them. Now, a standard lot starts from 1.002. I think it's 100. I think it's 100. Cool. Honestly, I've forgotten. When I thought we're going 200 lots, I think let's leave it at 100. I don't know. Honestly, I've forgotten. 0.00. This is a standard lot. Don't worry. Once we get to executions, I will show you. You will see. You will see what they mean. You will see, and I will even explain them now. Mini lots. Mini lot starts from 0.10 to 0.90. Trust me, guys, it's very simple. Please, if you are already panicking, just calm down. Calm down. Yeah. And then, of course, if you can, okay, I saw Rajo Bank is 150 trade. Okay, so, all right, for the sake of it, let's just say 1 to infinity. Because, of course, I don't think there's 1 to infinity. I think this saves me from any error. The mini lot is 0.01, 0.0, 0.01 to 0.09. Now, most of you might be wondering, what the hell is a lot size? Now, when a single pip, now if you're using a standard lot, every pip counts as from $10 upwards. From $10 upwards. If you're using a mini lot, your dollar count starts from $1, $2, $3, whether it be in profit or loss. If you're using a micro lot, your dollar count starts from cents. 1 cent, 2 cents, 3 cents, 10 cents. Now, for us to have a dollar, I think we need to have 100 cents. Well, 10 cents equal 100. Like a woman. Please, do we need to have it? Do we need to have 10 cents before we have a dollar, or do we need to have 100 cents before we have a dollar? Honestly, I forgot it. Okay, 100. All right. Please, if you don't understand this, just calm down. Wallah, it's very simple. Okay, 10 cents. 10 cents before we have a dollar. No, I think we need to have 100 cents before we have a dollar. Guys, just calm down. Wallah, this thing is very easy. And I know some of you are already
No, what
um,
sense now?
panicking. Eh? We need to have 10 cents before we have a dollar. Yeah. I think we need to have 100. We need to have 100 cents before we have a dollar. So this here, what this lot size means is it's simply a measure that gives you a sense of what a pip means to you according to your position sizing. So a pip might mean $10 to someone, a pip might mean $100 to someone, a pip might mean $1,000 to someone, and of course, a pip might mean $1 to someone, a pip might mean 10 cents to someone. So depending on your position sizing. So you use lot sizes to position size to size your positions, to size the trades you take. And you use your equity to calculate your position sizing. So if you want to risk 10 pips, you look at your equity. How much do you have? I have so amount. Well, how many percentage do I want to risk per trade? See someone using 3 standard lots, just say 10 times 3. If you see someone using 10 standard lots, you just say 10 times 10. So what you need to be aware of is the lot sizing or position sizing has three numbers, two numbers after the decimal point and one number before it. And the number before it could start from 1 upwards if it's a standard lot, before you see anything after the point. Now, anything after the point is either a mini or micro. The first number after the point is where the mini lot sizing starts from. The second number after the point is where the micro lot sizing starts from. I told you the purpose of today's session is to help you become aware, not to attain mastery, not to become fully aware, but for you to just become aware. These are things that exist in the trading world. I expect you guys to go on your free time and make research on how lot sizing works, how position sizing works, depending on your equity, of course. We get to leverage, we get to margin. But this is the most important thing. I think it's even more important than leverage. I can briefly talk about leverage now. Leverage is just a two-edged sword. Come on, it's money they borrow you. Your broker borrows you to trade, but it's a debt that you don't find yourself in debt. Even if you lose, you don't really go into their money when you're using leverage. So come on, Kaini, let me translate in house. Let me just speak English. It's like you're going to Lagos and you want to buy goods that are worth 10 million, but you only have 500,000. So where leverage comes in is I'm sorry, that was my mom. All right. Yeah. So where leverage comes in is, let's assume you're going to Lagos and you only have 500,000, but you want to buy goods worth 5 million. So your broker would, where leverage comes in is, your broker would, let's say, borrow you, loan you. Your broker would loan you a certain amount. So you literally have 500,000, but then you would be able to go to Lagos and shop for things, shop for goods as if you have 5 million. So the beauty of leverage and the ugliness of leverage is when it comes to losing, since you have so much money, the beauty of leverage is it's a two-edged sword. It will help you maximize your profit and it will also help you maximize your loss. Because since you are no longer going to Lagos with 500,000, you are going to Lagos as if you have 5 million. There's every tendency that you will misbehave because you think you have 5 million. You will misbehave, you start doing things like you're a big boy, and then before you know it, everything is gone. But then if things go right, of course, you would turn out to be a real big boy. So that's the beauty of leverage. There's a way we calculate leverage, which I will take you guys next time. But as I said, yeah, I think it should be part of what you should, on your personal time, just go and make personal research how to calculate leverage. When you open up your real accounts, I'm sure you might have chosen the leverage you want. There's something they call unlimited leverage. There's something they call 1 to 50, 1 to 500, 1 to 2,000. There's a way it works. Go to YouTube, find out how it works. Because once I start speaking mathematical, many of you will. Honestly, this lot size, and I'm sure there are many of you that are like, hey, I didn't sign up for this thing. I didn't sign up for any mathematics. No sites boring. We are okay, thank you. It's boring. It's not boring if they really want to learn. I want to learn. It's not really. All right. Please, guys, the concept of lot sizing, position sizing is very important. And of course, the concept of leverage and margin is also important because leverage makes you understand the amount of risk you are subjecting your account to. Position sizing also helps you understand the amount of risk you are exposing your account to. If depending on your equity, you will want to choose a lot size that will that will not blow up your account. Because if you have a considerable equity, 10 pips of standard lot is just $100. But if you have $100 in your account as equity and you go and use standard lot, 10 pips is literally boom, your account is gone. So if you have a loss of 10 pips and your account is $100 and you use one standard lot, 10 pips minus 10 pips of your account is literally everything is gone. So you will need to put your equity into consideration when doing your position sizing calculation. My FX book helps in doing that, but I will teach you how to position your size, how to do position sizing calculation manually. There's this secret manual formula I use when I want to calculate position sizing. I know my risk appetite. I know the amount of pips I want to use as stop loss per trade. I know the amount of pips that no matter what, I don't let my trades exceed that amount of pips. If a trade setup gives me an opportunity that has certain pips that has exceeded my risk appetite, I let the trade go. I don't take the trade. So depending on your strategy, depending on your risk appetite, you will get to do that in your trading plan. Yeah. Someone should have record, please. My phone's right off. Okay, yeah. Sorry. All right. I told you the purpose of today's class is to help you. Yeah. So risk management and trade management. What does stop loss mean? What does take profit mean? What does BE mean? Let me copy this thing. Why on earth am I unable to copy this thing?
Excuse me, sir. I have a question.
Okay, please go ahead.
Okay, sir.
Go
Sir,
ahead, sir. Go ahead.
you said something about 10 pipettes making one pip, right? Then what about if
Yes,
the
sir.
other
Yes, sir.
value? What about the other value? Like let's say the third decimal place before the pip. How many pips would does it has to count before the other value would increase also?
Yeah,
Like
that would
yeah.
mean 10. Exactly. That's a very beautiful question. 10 pipettes makes one pip. From one pip, we can go to 10 pips, 20 pips, 30 pips. But the pipettes need to keep changing from 1 to 10. So if from one pip, pipettes keep changing and we reach 9 pips, and then pipettes keep changing, we reach 10 pips, and then pipettes keep changing, we reach 11 pips. That's how it's going to continue. So when pips change to 11, I'm coming. When pips change to 11, now here currently what we have is 23. 23. So if this thing keeps changing, it's going to change to, if this thing changes, if the pipette changed to 10, we're going to have 24. If it changed up, 29, and then boom, we have 30. Please, I'm coming. So we will no longer have 23 here. The question which you raised, it's going to be 30. Can you see? So if this
Yes,
pipette
sir.
now
Yes.
change again, 1, 2, 3, up to 9, we will have 31. Boom, 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 boom. We reach 99, and then it wants to change to 100. What we'll do is, I'm coming. What we'll do is we'll have
2100.
100. You see? So if it wants to change to 101, 1 pipette, 2 pipettes, 9 pipettes, boom, 10 pipettes. So it will now change to 101. That's how to do it. That's
Okay,
how to
sir.
do it. It's
Thank
it's
you.
really simple, guys. Wallah, it's simple. It's very, very simple. The only reason why it's confusing is because I haven't navigated the MetaTrader app for you trading view. We haven't used it. So in my this is the first. Like The sessions are really, really fast. Sessions are really, really fast. So just calm down. In case it's confusing, just calm down. At your spare time, go to YouTube. Concepts of pips and pipettes, concept of lot size and position size, and concept of leverage. Once you watch a video or two, it will make sense. But Allah, it's really simple, guys. It's really, really simple. So just calm down. Just calm down. Just calm down. There is certain amount that no matter how you want to see some lot size, they will not allow you to. Yeah. Well, depending on your equity. Depending on your equity. There are certain lot sizes that you can't use if you don't have equity that exceeds certain amount. So they will be like not enough balance. Not enough balance. Once you place an order with a certain lot size that is way out of your account, that is way bigger than your account should normally have, they would tell you that inadequate funds. So yeah, position sizing. So what again? What was I even talking about? Risk management. Risk management. Now, a very beautiful disclaimer. Very beautiful disclaimer is forex is one of the most managed. Forex is one of the most volatile asset class anyone can have. Can financial, yeah. Forex is one of the most volatile asset class. Forex trading is one of the most high risk asset class. High risk. High risk asset class. Other asset classes that have lesser risks, asset class that include bonds and you want to say something? Real estate, real estate should also have a lesser volatility, meaning anything could happen. You could literally boom lose all of your money now, sharp, and you could also make enormous returns that are outrageous. So it's a two-edged sword. If you know your risk appetite isn't high, don't come into forex. It's a high risk asset class. Because it's a high risk asset class, the concept of risk management cannot be overemphasized. The importance of the risk management in this, when trading this asset class, cannot be overemphasized. There are several risk management strategies. There are many strategies in the trading world. The most important strategy is risk management. Because what risk management is no matter what happens, we will survive. And if things go our way, fine and good. If things don't go our way, we will survive. That's literally what risk management is. Taking risks that will not lead to ruin, that will not lead to life savings gone, that will not portray you as a gambler, rather as a speculator. So anything could happen. Risk management is simply acknowledging anything could happen and then deciding to take control of what you can take control of. Things like position sizing, things like I think this is the most important concept as far as risk management is concerned. If you have a good position sizing strategy in place, meaning you don't do what is out of your budget, you don't do what is out of your league, you cut your quote according to your size, you will survive. So if you have $100 account, you shouldn't be trading as if you have a $1,000 account. If you have a $1,000 account, you shouldn't be trading as if you have a $10,000 account. So you should know your account size and then position your trades based on that account size. You should position your trades based on risk appetite that your account can weather, that your account can sustain. If things go wrong based on your account size, you can survive and you can have room to make up for those losses at a later time. So whenever you hear someone say, I blow up my account, it only means he didn't use risk management. Because if you know what you're doing and then you manage risk, it's very difficult to blow up account. Because the basic mantra is do not risk more than 1% per trade. This is the general rule, not more than. That's the percentage button. So please, I'm coming. I can't cite the percentage in any way. Yeah, not more than 1% trade. So if you have, what it means is, if per trade you don't risk more than 1% of your account, it means you have to lose 100 times before that account that account vanishes. So if you know what you're doing, you will all agree with me that it's almost impossible to take 100 trades and lose all. If you know what you're doing, at least you 70% of the time you know what you're doing. It's only 30% of the time that you're wrong. So in trading, you will lose. So what losing means in trading is, it's just like expenses. Can you run a business without expenses? It's impossible, because you will have to buy goods. If you have employees, you have to pay them. If you have you have bills to pay, you have expenses. So in trading also, losing is your expenses. No business has no expenses. So, but you would want to keep that losing streaks at a bare minimum. You would want to make sure you manage risk in such a way that even if you lose, you won't lose everything. The same way that if you run a business, your expenses shouldn't be way more than any what's it called? Your expenses shouldn't be way more than your projected income. How can you spend 100,000 per day in your business as expenses, but then be expecting 20K per day? It doesn't make sense. So if you spend 100,000 per day as expenses in your business, at least you should be expecting something around 500K per day, 300K per day. That's the normal. I think that's, they call it risk to reward. We'll get there, but never ever have more expenses than projected income. If your expenses are way more than your income, there's going to be problem. So, but if your expenses are less than your income, then that's balance. Because no matter what, you would get away with something. So risk management, common terminologies associated to risk management are, well, I mentioned position sizing. You position size using lot size. You position size using lot sizing, using the concept of lot size. Lot size leverage. So these are things to lot size, leverage, equity. So when position sizing, you need to keep certain things at the back of your mind. Things that include equity, lot size, leverage. So that's the first thing. And you should make sure you don't risk not more than 1% per trade. Not more than 1% of your equity. So the money you have, don't risk not more than 1%. Risk not more than 1% per trade. So this way, it would mean that you would have to lose 100 times before your account is gone. So someone mentioned psychology. This is one of the beautiful ways to improve your psychology. If what you're risking is something that is way beyond, that is less, that you don't mind losing, you wouldn't sweat it. Farouk, yanzu dan ka bani 500, ai ba wani abu da zai rage ka da shi. So that's how that is. It also applies in trading. If you risk something that ordinarily wouldn't shake you, make you sweat, and you wouldn't mind even if things go wrong. So the only times your psychology gets messed up is when you are taking risks that are way out of your league. You agree with me on that? I think you want to say something. Okay. So if you want to consolidate your psychology, something more than yeah, no more than 2%. Trust me, because how much you do, I risk less than 1%. Sometimes I even risk 0.5%. So there's skill to it. Don't 1% is even so, it's too much for me. Let me even tell you. So if you have a decent account size, you can do it in such a way that you risk 0.25%, not even 0.5, not even half of a percentage. You can do it in a way that you will risk less than 1%, less than half of a 1% safe. So, Farouk, you will agree with me. If you risk what you can afford to risk, you would find your psychology intact. Gaskiya, if you have $10,000 and in that $10,000 you only risk $50,
Yes, yes.
would you sweat?
I
You will
agree.
not sweat. If you have $1,000, oh, so one of the best ways to improve your psychology is, well, try to make sure you know what you're doing. Kagani, try to just have a little confidence in your trading knowledge, in your trading skill. Okay, you are convinced that Gwargwado, to some extent, I know what I'm doing. I have a skill. That's one. Number two, have a decent account size. The account should be in a way that if you make a little from it, you would be content. And if you lose, it's big enough to sustain that loss. You wouldn't shiver, you wouldn't sweat it. So there are things that are not necessarily within you, but outside of you that you need to tweak one way or the other. Things like have a decent account size, things like try to have a good understanding of the market. Of course, it's a continuous learning journey. You can never know it all. There are multiple ways of making money from this industry. And if you try to master all, you will find yourself at the wrong side of the market. You would be wasting your time. So just try to find out about a number of concepts, master them, master them, develop confidence from them, and yeah, put them into practice. Because ultimately, I see people with so much knowledge not having a penny in this industry, and people that don't really know much but are executed making money. So ultimately, it all comes down to execution. Know enough to not be stupid. Know enough to not trade the market stupidly. Execution is where the results are being found. When you execute, you journal. You see, most of the things I'm writing down as against it, I'm touching them one after the other. Journaling, let me tell you something. One of my biggest problem, when, oh God, over trading was my biggest problem. And I told you the first day we had this session, the day I gave you guys a long pep talk as an undertone of this forex trading of a thing, your journey, I emphasized on over trading. Don't overtrade. If you overtrade, you're simply being a prostitute. That's really it. You're being either a male prostitute or a female prostitute. Because when you overtrade, you don't know what you're looking for. You don't know what you're doing. You don't know what you're looking for. Because if you know what you're looking for, you would wait for what you're looking for to occur. It's like you going to the airport to pick up your wife. Because you don't see your wife, you just decide to pick up anybody's wife. But if you know that you're at the airport to pick up your wife, you would wait for your wife to come, for their plane to arrive before you think about picking someone up. So when you overtrade, you don't know what you're looking for. Because you're at the airport looking for your wife isn't there, so you decide to pick up anybody's wife you see. So that's what overtrading means. And that's what being stupid in the market means. Try to know what you're looking for. Develop confidence in that thing. Be waiting for that opportunity to occur. If it doesn't occur in that day, close your phone. Next day. Next day it doesn't occur. Let it be. It's very rare if you have a solid edge, a solid setup that you are looking for. It is very rare for a week to go by without you having at least three opportunities. Of course, they might be busy. You might be carried away by the time those opportunities would occur, but it's very rare for you to go an entire week without having a single opportunity. So the more you are able to filter false trade, false trade opportunities, false signals, and then sticking with that setup that you've mastered to an extent, means sticking with that your wife that you're waiting for at the airport, you would find yourself in lesser trouble. You would find yourself not, your psychology would be intact. You'd find yourself more confident. You'd find yourself more calm, relaxed. You'd find yourself living the life of freedom that trading promises you. Because that's where freedom comes in. Not feeling the need to do anything. It's not just not feeling the need to work for anyone or go and do anything. No, it's also not feeling the need to trade. That's also freedom. not feeling the need to place a trade, despite there not being any opportunity for you to trade. So one of the ways to help you identify your perfect setup, your perfect trade opportunity. For those that are newbies here, it might seem really weird, all the things I'm saying. Just calm down. Just have it at the back of your mind. A day would come that it will begin to make sense. You begin to recall everything I'm saying here. And yeah. So overtrading is a very big killer. Overtrading is a problem because overtrading means you press buy, you press sell, you press buy. You are a trader, therefore you just have to press something. So the day I give you $20, Farouk, please get help. The money is yet to be deposited. The money has been given. The account officer, wallahi, it's not an easy thing. The day I did that giveaway, first airtime giveaway, I regretted it. So the money is with the account officer. He's yet to deposit it, but he will deposit. Initially, when we spoke with Abdul, he told me wait. He told him to deposit $10. I told him I said 5, not 10. So please just bear with me. Just bear with us. Your money would be deposited. I haven't forgotten. And yeah, so overtrading is a big problem. Overtrading is simply you being a prostitute, you being promiscuous, you following any lady you see, or you following any guy you see. You don't know what you're looking for. So at least have spec, know what you're looking for in a lady, know what you're looking for in a guy. If you see a guy that possesses those qualities, then go for him. If you see a lady that possesses those qualities, by all means, go for her. That's you knowing what you're looking for. That's you knowing your setup. So you journal your trades. It's all part of risk management. You not only do you journal the result of those trades, what made you take those trades, also journal your psychological state of mind the time you took those trades. Wallahi, it's not. Let me tell you a little secret. Just today, I deposited a live account, and because I told myself I won't be trading, but I just said, let me trade. I deposited at my live account and I placed the trade out. And then I just saw myself just come on sweating. I said, what is happening? Like, why am I sweating? What the hell is happening? What is up? I changed entirely. Because it's been a minute that I traded a live account. Since I blew that MFFK Farouk, I didn't trade any live account since then. And then I said, hey, I closed the trade because one, I wasn't supposed to take the trade at that time. I told myself there are certain times that I take trades. So despite the fact that I saw a trade opportunity and it did play out, but then I just closed it. But I saw it play out in my favor, but then I closed it. My psychology was just at me. I said, Kai. So honestly, there's so much power in trading. There's so much power because the psychological aspect of trading a live account would make you turn into a Buddha. It would fortify your state of mind, your psychology. You would no longer be a kid. You would no longer be, if you're a lady, you would no longer just be an ordinary lady that go I can. No. It would shape you. It would shape you into a more refined human being. So journal your trades, not only the results, not only why you took those trades, but the psychological state you found yourself after executing on those trades. It's a very important point to cover. So common terminologies associated with risk management are stop loss. By the mere phrase stop loss, you know that it's you stopping your loss. You have take profit. Yep. These phrases are self-explanatory. We have take profit. They are all figures that you look at the chart and you select. You point out and then you go and you type. You modify your. We get there. Please just be conversant with these terms. That's my goal for today. I want you guys to know about them and be conversant with them. We have break even, BE. Break even. We have break even. We have trail stop. We have partials. I think that's about it. open TP. There are other slangs. You hear them saying open TP, psychological stop. We have psychological stop, psychological. I'll explain them now, please. A psychological stop loss, psychological stop loss, open TP, manual. Okay. Now, these are all actions we take when, during, after a trade. Okay, before, during, after, yeah, before, during, after a trade. So it is very unlikely for someone to place a trade without doing either any of these or either. I don't know what the right grammar is, but you get the point. Once you open your chart and then you decide to trade, you will find yourself doing totally every. It is impossible. You, it is impossible to execute a trade without doing either of these things. It is impossible. You must do them. You must do either one or even all. I'll explain what they mean. Please, if you have anything to say to me, you can. I hope at the end of the class you tell us good journal. Yep, I have a software. I really sleep. It's a lecture you know, say, yeah, I will tell you guys it's a manual um position size and then my FX book. Yeah, please can you explain how to? Yeah, I will explain. Please guys, we have about a month. We have about 24 days now remaining. So just calm down. Just calm down. Some of these things we would go over them and God willing, we intend on giving you guys certifications the day I told you guys not to sleep, where some of you guys slept. Let me see. We intend on giving you guys certifications. As we spoke with Abdul the other day, and we intend on holding a small ball for you guys. And which I asked how many of you live in Sokoto. Should we be about making sure each and every one of you make it to Sokoto for the ball, for the little get together, or should we just forget it? Should we just mail it to you guys? Should we? We spoke so much the other day. For those of you that were awake, for those of you that are sleepyheads, you missed that part. So yeah, the idea of risk management and trade management. Listen, these are two interchangeable terms that you need to be aware of. Trade management. Guys, my job is to make sure you are aware of all of these things. My job is not to make sure you become masters of these things because it's really impossible for me to help you guys become masters within a shorter period of time. That's why I told you the month currently is March. Give yourself from March to December of consistent personal research and learning. Get yourself wet. Get yourself heavily involved in research and learning. What? Just a little bit. Ask questions. Just a little bit. Acquaint yourself with friends that are involved in trading. Ask them, guy, tell me something. Teach me something. I have a question. Call them. Hang around with them. Listen to their conversations. Ha. It's going to be really, really helpful. It's going to be really, really helpful. But we still have about 24 days, inshallah. So calm down. Before the month ends, we would have covered so much. We would have covered so much. God for that. Everything here, I would want you to have a theoretical understanding of it. Because by the time, everything here, by the time we go into the charts, you 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 see, I will talk about everything here before today's class. And let's see what's the time. 3 minutes. Oh, there's problem. Please, someone should screenshot this thing for me. Just screen because I don't want to. I will forget it tomorrow. I might add to it tomorrow, but at least now we've spoken so much about these things. So yeah, in the next 2 minutes, guys, should we call it a day in the next 2 minutes? Or should we continue? Should we call it a day in the next 2 minutes, or should we add another 30 minutes? Please type. Should we call it a day, or should we forge ahead and so yeah. Right. Okay, fasting, Kutuma. Oh. Okay, let's call it a day. Okay. Add 30 minutes, continue. Okay, let it be a vote. Let's keep moving. Okay, let me. You know what? Let's just finish risk management. Let's finish with risk management, and that's it. Let's finish with risk management. Let me just finish with risk management, and we'll call it a day. Now, there's risk management and there's trade management. There's risk management and there's trade management. This here, this is risk management. This here at the top, this is risk management. Of course, under risk management, we have trade management. It all entails, it encapsulates, risk management encapsulates everything. Everything you do to make sure you don't lose it all if you're wrong. Everything you do to make sure you don't lose it all if you're wrong is risk management. Everything you do to minimize your loss and to maximize your gain is risk management. Okay? Everything you do okay, let me not go and contradict myself. Let me be careful here. Everything you do to minimize your loss is risk management. Everything you do to minimize your loss and maximize your gain is risk management and trade management. After executing on a trade, you would want to manage that trade. That's where a robot is really messed up. There are things that you will see after executing on a trade, you'll be like, I think I should get out of this trade. So that's a trade management. You just exited. But before you initiated the trade, assume your mind skipped and you didn't conduct your fundamentals. You're not aware of your fundamental events that are at the corner that might likely shift the market after executing on the trade, and then you saw a red box news indication at the top of your notification slide. If you have my FX book installed on your phone, they will make sure they hit you up with those notifications. And then you're like, damn, today there's news, I better get out of this trade. You